Hello there, Maverick Traders. This is Imri, and I'm back with another video in my Maverick Currencies Elliott Wave educational series. Now, this video is going to focus on the 3 cardinal rules of Elliott Wave formation. And that's one of the things I love best about the wave principle, is that it is actually remarkably simple once you get down to the nuts and bolts of how to apply this analytical methodology. So there are 3 rules, that's it. 3 inviolate rules, and if you can follow these rules, you're going to stay on the right side of the count that you are tracking in any particular market more often than not. So let's get right into it. So the first rule is that wave 2 cannot retrace more than 100% of wave 1. Okay, so why do we have this rule in place? It's because if we have a wave 1 in progress, that denotes the start of a new trend. So if wave 2 retraces more than 100% of wave 1, as we see in this diagram here, then wave 1 could not be the start of the new trend after all. That's the explanation behind why this rule exists. Very simple. Rule number 2, wave 3 cannot be the shortest wave. All right, so typically speaking, in a 5-wave Elliott wave cycle, wave 3 is going to be your largest and strongest wave. The only exception to this rule is in commodity markets, where wave 5, or to this guideline I should say, is in commodity markets where wave 5 tends to be the strongest and longest wave. But whether you're trading commodities, currencies, stocks, it doesn't matter. The rule is that wave 3 cannot be the shortest wave. So this diagram shows a violation of that rule. And rule number 3 is that wave 4 cannot end within the price territory of wave 1. All right, so again, this diagram shows a violation of that rule, where we have wave 4 here, circle wave 4, ending within the price territory of circle wave 1. That is not good. If you are counting a 5-wave impulsive cycle and you have your wave 4 ending within the price territory of wave 1, then you did something wrong and you have to go back to the drawing board. Now, last but not least, here is a real market example of a proper 5-wave Elliott wave cycle, properly counted following those rules. So rule number 1, does wave 2 retrace more than 100% of wave 1? The answer is no, so we have a green check mark there. Rule number 2, is wave 3 the shortest wave? Clearly no, so we have another green check mark there. And finally, does wave 4, where my wave 4 label is, does that end within the price territory of wave 1? Absolutely not, or nowhere near, so we have a green check mark there. So there you have it. All 3 rules have been followed. We have a proper Elliott wave count here. In this case, this price chart is the US government bonds, the 10-year yield on a 2-hour time frame, and this is what a textbook Elliott wave count should look like. So remember those 3 rules. If you can follow those, you're going to be ahead of, I'm not even kidding, 90% of folks out there who claim to be following the rules and guidelines laid out by Ralph Nelson Elliott's discovery. That is now today known as Elliott's wave principle. So remember those 3 rules. You'll see on the right side of your Elliott wave count more often than not. Thanks, guys. See you in the next video. If you enjoyed this video, please make sure to check out Maverick Currencies. We're always looking for new or veteran traders to join our ranks here at Maverick. We are one of the leading prop firms in the entire world. We've been doing this for quite some time, and we have extensive experience in all currency markets, including cryptocurrency. So if you've thought about trading for a prop firm, or if you're wondering what prop firm trading is all about, please come check us out. Thank you.